AI is exploding, regulation in the US is getting clearer, and yet money is leaving Bitcoin ETFs. So the real question is simple: where is the capital going right now? Anthropic has just released Claude Fable 5, the first public version of its next generation AI system called Mythos. At the same time, the company is reportedly preparing for a potential IPO, just like OpenAI and several other major players. So why does that matter? Because AI is no longer just a story. It's becoming a direct investment product through public markets. Investors no longer need to spread their bets across dozens of projects. They can simply buy exposure to the leaders. And that's changing how capital moves. We're already seeing it. Bitcoin has barely reacted to the announcement. Smaller AI-related tokens saw limited gains. Overall, the market is reacting less to individual AI headlines and more to the broader appetite for AI-driven growth. Now, let's talk about Bitcoin ETFs. US spot Bitcoin ETFs currently hold around $77.5 billion. That's roughly the same level we saw shortly after the 2024 election. But at their peak in late 2025, that figure was closer to $169 billion. In other words, more than half of those inflows have already disappeared. What's interesting is that this is happening while regulation is actually improving. The SEC is stepping back from aggressive enforcement and Washington is moving towards clear crypto legislation. Normally, that would be bullish. Instead, ETF flows have weakened, with more than $5 billion leaving Bitcoin ETFs over the last month alone. So why is that? Because capital is rotating into AI, into high growth technology, and away from assets perceived as higher risk. Add inflation concerns, add interest rate uncertainty and geopolitical tensions, and investors become even more selective. This isn't necessarily a rejection of crypto, it's a competition for liquidity. Europe appears to be adapting to that reality. One of the key architects behind MiCA recently argued that the European Union should avoid introducing additional DeFi regulation. Instead, Europe should focus on tokenization, real-world assets, and institutional blockchain adoption. The reasoning is quite simple. DeFi is difficult to regulate because there is often no company, no CEO, and no central entity to supervise. But tokenization is different. It's something institutions understand, something regulators can work with, and something traditional finance can adopt at scale. At the same time, MiCA is entering its final implementation phase. That means crypto companies operating in Europe will soon need to fully comply or leave the market. The direction is becoming increasingly clear. Europe isn't trying to eliminate crypto, it's trying to institutionalize it through tokenization. So now, let's connect the dots. AI is absorbing capital. Bitcoin is behaving more like a macro risk asset. ETF flows are weakening despite improving regulation, and Europe is building infrastructure for institutional adoption, or at least trying to. The takeaway is simple. Crypto no longer moves on crypto news alone. It moves with global liquidity, macro sentiment, and where large pools of capital decide to go next. And right now, AI is setting the pace. That was Watchpost for you. If you like this episode, follow, give it a like, so you never miss the next one.